Risk and insurance diligence is often overlooked in small and mid-sized business M&A deals. In this video, I'll explain why I think that's a mistake and provide some examples of situations where our advice helped ease transactions and provide value to the buyers and the sellers. Hi, I'm Gordon Coyle. Welcome to my channel where we talk about the risk and insurance issues on the minds of business owners. As an expert business insurance broker, my job is to help you make better decisions around insurance. If I can help you, please reach out and connect. But before I begin, can I ask you to do me a favor and hit that like and subscribe button? Thanks. All right, so let's start off by how I define small and mid-sized transactions. Typically, these are deals under $25 million in enterprise value, and very often they're in that $2 to $5 million EV range. They are often transactions facilitated by business brokers, M&A advisors, and other transactional professionals in a variety of different industries. Now, let me describe what risk diligence is for this market segment. Risk diligence is the process of having a skilled broker like me or a consultant examine the target company's insurance policies and related reports in depth for the benefit of the buyer. Risk diligence gives the parties to the transaction a better understanding of several critical factors, including 1, the adequacy of existing coverages and the need for adjustments post-close and what budget considerations need to be made for those adjustments. 2, the existence of coverage gaps and exclusions or missing policies and coverage forms that may affect the buyer, and again, the cost considerations to fix these problems. 3, the assessment of insurance costs moving forward. What does the new program look like? Number 4, understanding claims experience and potential rough spots operationally that could be problematic in the future for obtaining insurance or seeing higher price increases. Number 5, discussing the required runoff of claims-made policies and how to handle them properly. Number 6, recommendations for post-acquisition insurance strategies. And number 7, analysis of claims and pending claims and addressing potential claim severity issues that can impact costs and enterprise value. Overall, risk diligence gives the buyer a comprehensive understanding of the seller's risk landscape and how well it has been managed. It enables a more informed decision-making and strategic planning process for onboarding the acquired entity. A thorough risk diligence process helps mitigate potential unaddressed risks in the transaction, leaving the buyer open to unplanned costs, potential liability, and financial losses post-close. Without this level of assurance, buyers may unknowingly acquire unnecessary risks and costs that impair the deal value. Why does diligence make sense? I've been pulled into last-minute negotiations to resolve insurance issues that have not been discussed or reviewed prior to a deal's closing, and that finish line time is not a good time to find out that there are insurance protections are missing or that policies currently in place are not assumable. Being prepared and informed well before a closing helps eliminate surprises and unnecessary fire drills. I realize everyone wants to close a deal in a timely manner, so engaging us in risk diligence early helps avoid problems. Here are just a few examples of what our diligence reports have turned up in the small business market over just the past few months. The first situation is a seller had over 100 employees but never purchased employment practice liability insurance to protect them from potential wrongful employment acts. The buyer, a bit more savvy, required coverage to be in place retroactively for claims that could arise post-close for the acts that took place from the old employer before the close. We arranged the coverage, the buyer was happy, and the deal closed on time. The second example, on behalf of the buyer, we analyzed the insurance policies of a contracting firm and identified that the payroll used in rating the company's general liability policies to be off by more than $200,000. This policy was to be replaced post-close and would have created a $6,000 additional premium on audit. That $6,000 was marked off in the seller's proceeds to account for that difference, and if it hadn't been identified, it would have come out of the buyer's pocket. Example number 3, in a distribution company where several trucks were used daily for deliveries, we told the buyer to ask the seller for a historical report on all the driver's motor vehicle reports. The seller never ran MVRs, which they should have been doing all along. So when we suggested that the buyer obtain permission to do so, they did, and got the MVRs and found that several of the drivers should have been ineligible for driving duties for years. This put the deal on ice until the seller could find and hire eligible drivers. The buyer was disappointed, but happy that we identified this potential liability risk before they inherited a pool of drivers with poor driving records. In my final example, the seller is an e-commerce business, and we identified several missing coverage parts, including, most importantly, cyber insurance protection. We estimated the cost of rebuilding the coverage portfolio, including the missing coverages, so the buyer could properly establish their pro forma budgets. While some of these issues may seem minor, they weren't minor for the buyers we worked with. Getting the protection right and knowing the issues we discussed and covered were critically important to the buyers and the offers they were making on these deals. So, what does it cost? For most small business deals under $10 million in enterprise value, we charge a flat fee of $2,500. For EVs over $10 million, I'm open to negotiate these fees. For buyout firms with a regular volume of deal flow, I'm also open to negotiating special rates. One last point. I'm a big fan of M&A insurance, a form of coverage that both buyers and sellers can deploy to protect them from the potential liabilities arising from the representations and warranties made in a transaction. I've done a video on that which you can view here for more information. But if you'd like additional information on how we approach mergers and acquisitions, including diligence services, and how we can shepherd your deal regarding insurance as well as M&A insurance, please reach out and connect. My contact info is in the contact or description box below, and I'd love to hear from you. Thanks.